Welcome to the June 6, 2014 podcast for the Green Energy Channel. Today's title is The Bellwethers Have Rung, and gold's low may now be in place. At the end of last week, I felt like the only gold bull on the planet, so negative was the sentiment towards the yellow metal. Many people were talking about a triple bottom near 1200 and were saying that gold would have to dip below 1000 before the correction was done. The bearish view had a strong logic behind it. People who look at seasonal patterns might know that one of the 2 or 3 most bearish periods of the year tends to be from late May into mid-June. Meantime, fundamentalists were saying that the U.S. economy was going to have a better quarter. That's supposed to be bearish for gold, isn't it? And others were talking about how an easing move by the ECB might trigger a rise in the dollar, and that would certainly bring a further slide in the gold price. Pure chartists also had a good reason to be bearish. Since late March, gold had spent more than 2 months traveling up and down in a narrower and narrower range, moving in what some people call a triangle. A break out of a triangle often brings a sustained move in whichever direction it breaks, but not always. On May 27th, gold finally broke the lower end of the triangle and dropped $29 in a single day, and on fairly decent volume too. In just 2 to 3 days, it was down near $12.50 and threatening to go lower. The chartists, even on chart-savvy places like Kitco, started lowering their forecasts and were talking about technical damage and how the gold price would need to go quite a bit lower. I felt like the lonely guy who no one wanted to listen to when I said this might be a head fake. Instead of going with the flow and going along with the predominant bearish sentiment, I thought it would be better to listen carefully to the small and subtle signals that the market itself was giving to us. I made many postings about small cross-market signals in my daily diary. First, I noticed a ratio, which I have now dubbed the gold to anti-gold ratio. This name comes from Rick Rule, who has the idea that U.S. T-bonds are the anti-gold asset. The ratio is something simple, but not often used. It is actually a ratio of gold to TLT. That's the ETF for the U.S. long bond. On Wednesday last week, and also later in the week, the ratio made a nice double bottom near 11. By the close on Friday, we saw gold at 1250.5 and TLT was at 114.10, giving a ratio of 10.96. At that level, people could exchange about 11 shares of TLT for 1 ounce of gold. The ratio had been as high as almost 14 shares per ounce at gold's peak back in 2011. The historical chart told me this level might be important. It lined up almost perfectly with the lowest level of the prior 3 years. In fact, the low last year was 11.02. It made that ratio on a significant day at the end of June 2013. The exact same day when gold made its major low at 1186. So we were seeing a major double bottom in this ratio. I could not help but think there must be some people who are out there who are holding bonds who are beginning to consider this might be a great time to start moving aggressively out of T-bonds and into gold and gold shares. Sound logic might tell them there's no reason to be heroic and hold onto a high-risk asset with an almost risk-free return, an almost return-free instrument like bonds, when you have such an ideal opportunity to switch into gold and preserve your wealth in a hard asset. Getting 1 ounce of gold for only 11 shares of TLT has got to look pretty attractive when you consider where it's been historically. Next up are my bellwethers. That's what I like to call a small number of premium gold shares, which have a tendency to bottom a day before or even a few days before the gold price does. Right now that list includes Royal Gold with the symbol of RGLD, Franco-Nevada, FNV.T, and GDXJ, which is the ETF for junior gold shares. In the chart, I compare the movement of two of these bellwethers with GLD. The bellwethers reversed to the upside late last week, ringing an important bell for me, and that bell went on ringing again yesterday. RGLD is now 10.5% off its recent low of last week and is actually 1.6% above the level when gold broke through the triangle. GDXJ is up 7.7% from last week and is only 1.5% below the gap. GLD is relatively weaker, only 1% above its low, and 3.1% below the gap down date. So you can see the bellwethers are running ahead of gold. Now, if these markets continue to follow the pattern that I've seen at previous major lows, then gold and gold shares may go on rallying, and GLD may get dragged up, filling the gap and moving above the pinch point in the old triangle. That's at about GLD 125. I suppose that is when the nervous bulls who exited might start thinking about getting long again. The technical function of moves like this one are a sort of head fake to get many traders on the wrong side of a trade before an important move. Stale longs sell out when gold drops below the triangle, and bears rush in to take a big short position. It gets everybody lined up with the wrong position in the market. Then the market tricks them and moves higher, and one by one they realize the market isn't going down, and they are forced to cover shorts. And that adds extra fuel pushing the market higher. Along the way, the reluctant bulls who sold out rejoin the party on the long side, probably paying more than if they just held on to their longs. So I think we are seeing here something like a classic setup for a head fake. Even so, I cannot guarantee we will see a strong bull market starting here. Please take note. I will go on listening to the small day-to-day signals from the market, and if the indications start looking different than I expect, I will point that out. I have gone on record in my May 15th video saying that I expected a major low before the end of July 2013. I believe we have now seen that. In fact, I started buying last week when the gold price dropped and continued yesterday. I am mainly focused on highly leveraged situations, and that includes some call options with a maturity of at least January 2015, when I think the gold and gold shares could be much higher than they are today. I will describe these investments in more detail in my diary. Have a look there if you are interested in the day-to-day commentary. I don't always get it right, but I do think you will see some charts and other ideas that you might see nowhere else. Oh, and please feel free to share the URL of this video with anyone and everyone you think will have an interest in these comments. I am hoping to do more podcasts and also some interviews, and on a regular basis. It would be great to have a larger base of free subscribers, so please join in and have your friends too. Thanks for listening.